Welcome to Copytraders Club, where you can learn how to make more money copy trading. I am Gavin Macaulay, my name and username on eToro. Today I chat with another of my popular investors. He plays a unique role in my PI team, and his recent performance has been wonderful, even during difficult times. So let's find out why. Here we go. Episode 10 of Copytraders Club, and this will be an interesting one as we have the third of my 4 PIs joining us today. Unlike the first two, he's not a stocks and shares person. He specializes in trading volatility. I have very little idea what that means and entails too, listener, don't worry. We will learn together. And who better to teach us than Marco Willekens, aka EliteVol. He specifically asked in advance what time the limo was picking him up. Well, it obviously all worked out fine because here he is. Marco, welcome to Copytraders Club.
Hi, Gavin. Thanks for having me.
Well, we're delighted to have you. Let's get past reception and these quickfire questions. Are you ready?
Ready.
Username on eToro.
EliteVol.
Date you joined eToro.
September 2nd, 2019.
Year of birth.
1983.
Place of residence.
Leuven, Belgium.
Profession.
Systems engineer.
Briefly state what you aim to achieve on eToro.
I want to provide an alternative investment technique as opposed to traditional buy and hold investing.
Name one of your investing heroes.
Jim Simons. He's the head of Renaissance Technology, creator of the Medallion hedge fund.
Name one of your favorite investing books.
It's the VIX Trader's Handbook. It's a book by legendary SIBO trader Russell Rhodes.
That completes the formalities. The magnificence of the VIP lounge awaits us. Marco Willekens, aka EliteVol, are you ready for this magical transition?
I can hardly wait.
So Marco, you're from Belgium.
Correct.
Are you a francophone or Flemish speaking?
I'm a Flemish speaking.
Ah. Moi, je parle un trop petit peu de français, but it would be an exaggeration to say, ik spreek een beetje Vlaams.
Perfect. Absolutely perfect.
Well, thank you to 1 Minute Flemish Lesson 3. So there's nothing too impressive about that, but what is impressive is that you have a master's in archaeology.
Yep.
Right, let's dig into that a little. Did you break any new ground in that academic field?
No, I didn't really engage in any field work. It was mostly just theoretical. No, I mean, growing up, I was always interested in history, actually more precisely prehistory, except that, so that's paleontology, not archaeology. But here in Belgium, there aren't many opportunities to go deeper in that, literally deeper. So yeah, I studied archaeology, had a lot of fun doing it, but I was always more interested in, or getting more interested in the technical aspects of it. So you learn a lot about statistics and mathematical techniques and dating techniques for objects. And I was always very interested in that and never really proceeded into it. So right after I got my degree, I ended up in IT, learned how to program, got also very interested in that, and basically been doing that ever since. So yeah, it's not your basic path going from archaeology down throughout IT to trading, but it's the path I followed.
You weren't out dusting down dinosaur bones or anything like that. It was just the theoretical study.
Exactly, yeah. I did some field work, but that's mostly local field work here. So it's not like I went to Egypt or to a faraway land to uncover ruins.
So you weren't down at the beach at Raversedi?
No, sadly not. No, there was indeed a very important archaeological dig there.
Now, here's a new feature. This is a question from a book called The Art of People. And it's a book I'm reading at the moment that includes 10 questions aimed at helping you get to know someone better than indulging in dreary small talk.
Okay.
Can you pick a number between 1 and 10?
Okay. 9.
Number 9. Who has been the most important influence on you?
My wife. She is she is basically my driving force. She pushes me to go forward, and she is a great inspiration to me. And yeah, I appreciate her a lot, and I treasure her a lot.
That's a lovely answer.
Thank you.
Okay, so Marco, you're a volatility trader.
Yes.
Which very basically means you make money on a single index that measures near-term volatility. The instruments you use increase or decrease in value depending on how volatile the market is likely to be.
Correct.
That's my understanding of it. Is that an acceptable short answer for now? We'll get into it more later.
It is very acceptable, yes.
Let me talk about how I first came across you. In my first couple of months on eToro, I saw your name come up on Felix Falix's YouTube channel, where he did a PI review of you. And also through the Copytraders Brian J. and Victor Zhang. So your name kept appearing. It appeared to me you had quite a high profile, but in fact, it seems you don't, especially as a PI. It seems most copy traders don't recognize the value of having a guy like you among their PIs. So that may be a good place to start before we get into the nitty-gritty. Why should you or a guy like you be considered a good option to have on a copy trader's team of PIs?
Diversification. I think the VIX is an asset class, and I think it is very underappreciated. Very few actually take into account volatility, and that is very sad because it is in fact extremely important. If you understand the concept of volatility, you will see that it has an enormous impact, or can have an enormous impact, on your returns. Most people look at it from a negative perspective, and they associate volatility with negative connotation, like there's a lot of volatility, so that means that the market is choppy, the market is probably in a downward trend. Doesn't necessarily need to be that way. Volatility works both ways. Volatility also works on the upside of the market. I see very little portfolios that actually utilize volatility. And in a way, it's understandable because it is a very difficult concept and it is not an easy thing to trade. You need to understand about the underlyings. You need to understand how it works. You kind of need to understand how it is calculated in order to successfully use it. And I think that also scares a lot of people away. They're like, this is something maybe that I don't understand. I don't want to get too deep in. Let's not fixate on it, and let's focus on stocks and commodities, etc. So I feel that in that way it is underappreciated, and I want to provide this as an addition to people's portfolios.
Great. Well, let's see if our conversation today can shed some light on it and maybe convince the listener who maybe hasn't considered it before that it might be something worth thinking about. So we're going to get into the nitty-gritty shortly. Before we do, I have a question from some social media stalking that I did as part of my research. Let's see if you can get the answer right to this question.
Oui.
The question is, can you perform under pressure?
Yes.
Well, I'll give you a clue. That's not the answer I'm looking for. It's a joke you posted on Facebook. The question is, can you perform under pressure?
No, but I can do Bohemian Rhapsody.
Turning now to your bio. Marco, would you like to read your bio on the right-hand column?
Sure. Turn volatility to your advantage. I'm a trader with 10 years of experience trading futures, options, and derivatives, with a primary focus on volatility and market psychology. I have developed a systematic, rules-based trading strategy focusing on the VIX index and other key indices, which generates a robust and consistent return rate. It is designed to quickly adapt to any external market situation by methodically using a set of technical and historical volatility indicators with a backtested track record, utilizing strict entry and exit criteria for each trade. The EliteVol strategy is a perfect fit for anyone looking to hedge or diversify their portfolio with the VIX as an asset class. Copy recommendations: minimum copy amount $200, copy open trades, minimum copy duration 6 months, recommended stop loss ratio 80%. If you have any questions, please let me know.
I have a few questions. What is the VIX and how do you make money off it?
So the VIX is basically a calculated number. It's a calculation of implied volatility. So volatility meaning the daily movements of any underlying asset, daily fluctuations in price, volatility, respective to the S&P 500. So the VIX is linked to the S&P 500 through the options that are traded on this index.
Let me read you some things that I have found and you tell me if this is a good explanation. Here are the baby step introductions to what is the VIX that I did for myself. The VIX is not a stock or a commodity, it's an index. It's a measure of the expected price fluctuations in the S&P 500 index options over the next 30 days. It's often referred to as the fear index. Do people say that?
Yeah, that is exactly how people call it, yeah.
So when the VIX spikes, when the chart of the VIX spikes, it indicates that people are nervous about what's going to happen over the next 30 days. Is that right?
Partially, yes. Yeah, I'm saying partially because it works both ways. So even though historically when the VIX is high, people have associated it with panic and fear in the markets, the VIX can also be high in case of market euphoria and optimism. Because since its price is derived from options premiums, option premiums will also rise if there is a lot of demand for these options.
So when the number of the VIX goes up, it's an indicator that there's going to be market movement over the next 30 days. That's a better way of putting it.
Yes.
There's not going to be a flat market.
Exactly.
If the VIX number is low, there's likely to be a flat market.
Yeah, exactly. That is a better...
So it says in this extract that I have, the most significant words in that description are expected and the next 30 days. The predictive nature of the VIX makes it a measure of implied volatility, not one that is based on historical data or statistical analysis. So let's be sure I understand. The VIX is a forward-looking measure of fear, and it moves up and down. No. It's a forward-looking measure of market movement, and it moves up and down all the time like any other index. And you can trade anything that has movement. It moves not at the same time and proportion as the S&P, but in advance of it, and probably at a magnified level if volatility is foreseen. Does that sound correct?
Yes, there is indeed a linkage with the S&P. There is an observed correlation. So usually when the VIX spikes, you will see the S&P move in the opposite way. But this is, like I said, an observed correlation. It is not necessarily a theoretical one. In fact, and this is very little known, but the VIX 20% of the time, so 1 out of 5 times, will move in the same direction as the S&P. So Actually, yesterday was a perfect example of it. At least the first half of the trading day, the S&P was up almost a full percent, so we were nearing 4,000 on the S&P 500. The VIX was up, so the VIX was actually higher in the morning, and that was because of, you can actually say that it was because people are starting to get greedy, and you see that greed element come into play here in the index. Now, we didn't close like that. In the end, the VIX went down, as one would expect would happen on such a positive day. But it was a perfect example that this correlation is not necessarily always there.
That makes it sound like a difficult thing to predict. So how do you go about trying to predict movements in the VIX?
So basically, the VIX in itself is not tradable. So you trade it through these derivative products that are basically derived from it. However, you can catch certain by observing the VIX movements. I'm not going to say that you can predict what is going to happen, because you cannot. It's not because I see that the VIX is moving in a certain way that I see, tomorrow we're going to have a spike in the VIX. No, it doesn't work that way. But what you can see is that it gets compressed to a certain level. So, for example, when the VIX hasn't done any large moves, either to the upside or to the downside in a couple of days or weeks, there is something brewing. You don't really know yet whether that is going to be to the upside or to the downside, but when it gets compressed, and this has happened time and time again throughout history, you get this kind of explosion move. Doesn't need to be an extremely large move, but when I say explosion move, that it gets out of that contraction. And by basically setting up your trades, you can basically play into that and play into this volatility that is coming. And like I said, the good thing with these derivative products is that you don't need to be right on the direction. You just need to be right on the magnitude of things.
Okay, so maybe this is a good time for you to tell us about the two instruments you use. If I click into your portfolio, there's only two things in it: the SVXY and the UVXY.
Yes.
Can you tell us in layman's terms how you use those two?
So actually, there are three volatility products on eToro, and I use all three. So currently, I have two in my portfolio, but the third one is actually the one I use the most frequently. So these three are VXX, UVXY, and SVXY. All three are basically products that are ETNs. So I'm not misquoting that. It's not ETNs, not ETFs. Exchange traded notes, which are different from exchange traded funds in the sense that the funds don't need to actually hold the underlying assets in their portfolio. So basically, when you trade, let's say, an ETF on oil or an ETF on gold, you know that you're actually buying, or that these funds or banks actually hold this commodity in their stock. With these products, they don't, well, of course, you cannot hold the VIX because the VIX is not a tangible asset, but they also don't need to invest in basically anything. So they're ETNs, exchange traded notes. They're basically pieces of paper that you trade back and forth. All three of the products, VXX, SVXY, UVXY, they hold a certain amount of VIX futures in their basket, and they do daily rollover to emulate the 30-day structure.
I think that's enough information on these very technical assets. Going back to your portfolio and your stats page, one thing I wanted to talk to you about was risk. Now, a couple of episodes ago, I looked into the idea of risk and what the risk score is on eToro and what it isn't, and how much should we pay attention to it, and if it's not what it might appear to be or what you might assume it is, how much more work do you need to do? I can rationalize all that in my mind for stocks and shares guys. I can have a rough idea if I look at a stock portfolio I can point to things and say, oh, that's risky behavior. That's a bit risky. That's very safe. There's a bit of hedging. I've no idea what I'm looking at when I look at your portfolio. So I want you to give me an idea. How do you feel about the risk score you've been given on eToro?
Well, me personally, I would consider that the risk score may be a bit higher than what it should be. And that is also caused by the fact that it's very difficult to. I mean, I understand why I usually fluctuate between like a risk score of 5 and a risk score of 6 over the past year.
Well, I'm looking at your 12 months. Yeah, it's actually between the green bar of 4 and the yellow bar of 5. Max risk is kind of between 5 and 6.
Yeah, so I always refer to max risk because I feel that is, it's the maximum. So you want to know what your maximum risk is. Now, I understand the logic behind it because since I only trade a couple of products, the way that you categorize risk, is more centered in general. Of course, you can say the same thing about a person who is trading like, I don't know, 200 or 300 stocks. Basically, they can also exchange all that and just invest in the S&P 500. And with the S&P 500, you're trading 500 companies. You're actually very, very well diversified. But since it's only one product, you could say that the risk score is not really reflective of that. Now, these volatility products are inherently more riskier than, for example, a Google or an Apple as a stock. You cannot hold them as long-term investments. They need to be traded. They are designed to be traded. The reason for it is because they don't follow the normal flow of stocks or ETFs or any other product. You need to count for decay rates that are present in these products, which will cause their value to drop over time.
When I looked into all the elements that eToro used to calculate risk, I was thinking about your portfolio and some of the things that they assign certain scores to are choice of the instrument and percentage of equity that is invested on a single instrument.
Mm-hmm.
So if they consider UVXY a risky instrument, and they see that you've got 40% of your bank or whatever in it, as you do currently, you've got, I think, 40% in one, 20% in the other, and 40% in cash, something like that.
Yes.
I wonder, does that make your risk score higher than it is in reality? Because what they're doing is trying to apply a uniform set of marks out of 10 to various different things, and you can't compare apples and oranges.
Exactly. I think so. I think that is correct. I agree. I understand, of course, their approach. You need to come up with a certain scheme that assigns risks to a portfolio, and you cannot do that on an individual basis because you have so many clients on eToro that it's just impossible to do so. So yeah, it is in my opinion higher than reflects the actual risk.
Hey, hope you're enjoying today's show. I'm sure you've subscribed already. If you're a successful copy trader, happy to share what you've learned. There's no need to have a public profile. Please get in touch. Otherwise, listener, the bigger the club, the better for you. So tell people on eToro about this show. Ask your PIs to come on. That way you will get to know them better. We build this club together. What else can we see on your bio? Copier number's 141. Seems very low for someone who provides what appears to be an important part of a balanced portfolio. Assets 100 to 300K. Do you feel underappreciated by copiers?
Well, it is noteworthy indeed that over the past couple of months, my copier rate has actually gone down pretty substantially. I had my initial spike last year in March when we were performing really, really well during the Corona sell-off. It got a secondary spike in, I believe it was August, when the portfolio also had a bit of a bump upwards. But yeah, what I have sensed is that the day that I got the majority of my new copiers was actually the day that the market bottomed in March of 2020. I remember that day I got close to 100 new copiers in a single day. And this was partially explainable by the fact that the VIX was everywhere at the time. The VIX was at that moment around 85, was the highest levels that the market had ever seen. There was panic everywhere. It was also all over the news. If you turn on CNBC, or the VIX was all they talked about. Well, of course, Corona is all they talked about, but I mean, market-wise, the VIX was all they talked about. So I think a lot of people, first off, they got scared and they were looking for ways to protect their portfolios, which were down pretty tremendously if you were following basically the S&P 500 or the NASDAQ. So they were looking for ways to hedge or to protect their portfolios. The VIX was getting more market attention. And I guess people started to notice me. But what is very, a little bit sad is that happened on the last day of the large sell-off. So the market started a rebound, and it has been rebounding ever since, actually. It's been more than a year now that we've been in this upward move, at least when U.S. equities are concerned. And the people are, I think, because when I look in my stats and I see the people leaving, they're not leaving with red statistics. They're not leaving with negative returns. I think they just are like, hey, this is over now. The market isn't going to be choppy anymore. It's just from here to the moon. We don't need this type of protection anymore. We can get returns here. We can get returns here in these products and these sexy stocks that we want to own. Yeah, I think it's just the way that it is. I remember that just before the crash in March, I also was declining in Copiers. I also had that initial bump very early on, I think in December even of 2019, because I was doing a lot of posts at the time and I was getting a lot of attention because of it. So I think it's just human behavior that when everything is going well, we don't like to think about these negative things, and we just tend to push them away into a corner, and let's worry about it when the time comes. And sadly, sometimes that can be done too late, and then you're
Yeah. So nobody wants to know you when times are good, but when things turn nasty, they all come running.
Well, that was the case last year. I don't know if it's going to be like that in the future, of course.
So you're really an insurance policy, kind of. The way you talk about it, people aren't interested when times are good, but those that have you are happy to have you when things get rocky, right?
Yeah.
And in fact, my portfolio right now is probably a good example of why it's a good idea to have a PI like you. My March results. Now, March was quite a rocky time for many people. And I did add some money to my account in March. But anyway, these monthly figures do still tell a story. I've got 4 PIs. Samosa King, who's 55% of my bank, down 5%. Trade Better, who's 10% of my bank, down 5%. Robert Merck, who's 25% of my bank, up 7.5%. And EliteVol, who's 10% of my bank, up 12.4%. And at the end of a pretty rocky March, where I was down quite a bit at one stage, I close it out slightly in the green, which, given how tough March was for many, and was for me at an early stage, is a very pleasant result. So is that not good evidence for why it's sensible to have the insurance policy that is EliteVol?
Exactly. And I'm happy that you mentioned it like that. But when you say insurance policy, it works both ways, because I have observed that my trading strategy works very well as long as the market makes moves. So This month, in the end, the S&P didn't really go down. Even the Nasdaq, it closed out the month green. So if you would have just purchased shares in the beginning of the month in any index, held them to the end of the month, you would be up. The problem is that it was a very bumpy ride. March had a lot of volatility throughout. So I like to profit from that. So this is why, even though in this particular month we didn't see a crash, the portfolio still performed really, really well. So it is good to talk about it in the sense of an insurance policy, but also it's perfect proof that it's not necessarily. I also try to profit from other types of moves in the market.
Sure. Well, I think there's a lot of people who are scanning PI stats to see what they did in March. And if they see 12.4% up compared to what their hot stonks guys did, you might see some copier number increase as a result of that.
Would be great. Yeah, hope so.
I was thinking about the ways that people might copy you. One is the way I do, keeping you as a portfolio fixture to hedge against volatility. Number two, people who use you as a short-term option, maybe get in and get out as soon as there's a bit of upside. And number three is what we talked about earlier, people rushing to you when, as an emergency measure, when the market is tanking. Are those your three main experiences of people copying you?
Exactly right. Yeah. I mean, there isn't really a right or wrong way to copy me. I like to provide, steady returns over time, just like any other trading strategy. Basically, for example, if you're looking for a permanent hedge, the strategy is good. If you're looking to hedge against a specific event, for example, let's say that there's a presidential election coming up, then you would probably be better off buying a specific product and holding it until the event goes away. But the big advantage with my trading strategy that I want to provide is that you don't need to worry about any of that. You just allocate a certain percentage of your capital, and I will try my best to utilize it in the best way possible and to protect that capital and to make it grow at the same time.
And do you recommend 10%? Did I see that somewhere?
Yeah, indeed. Sometimes copiers ask me, or potential copiers ask me, what is the best percentage to allocate? And I see sometimes copiers that are putting their entire money, so 100% of their amount in my strategy. Now, you can't do that. There's no, I mean, you're perfectly okay to do so. But if you are wanting to have a non-correlated, diversified portfolio, it's better to spread it out a little bit. So I usually say 10% is a good amount. Basically, also depends on your personal situation and how risk averse or you are. Because if you're like, hey, I don't care about risk. If the market goes down, doesn't matter. It will go back up again. I will hold and I will see where it goes. Then you will have a whole different perspective on things and.
And is there a bad way to copy you?
Well, a bad way would be to just, what I also see, people copying for a couple of days. They just stay for a couple of days, get almost no returns, or sometimes even negative returns, depending, and then they immediately bail out. So it's not like my strategy is not going to go through a drawdown. It's not like this is this, this magical thing that only goes up. Just like any other strategy, it will go through drawdowns. Of course, the trick is to keep those drawdowns limited, to keep everything going as good as possible.
Yeah. Well, speaking of downward movement, you had a big dip in January, which caused you to revise or refine your approach in some way. And the dip was connected to the whole GameStop story. I see in some of your answers to questions on your feed.
Yeah.
Can you tell us a little bit about that?
Yeah, so in January, there was the big story on GameStop and Wall Street bets, the whole army of retail investors that was pouring into the stock. And basically, it caused an earthquake in the options world. Why in the options world? A lot of the GameStop trading is going on not on the actual stock, but in the options on the stock. So you had especially the call options. You have call options and put options. Call options on GameStop were being bid with extreme premiums. Premiums that, okay, I'm not trading for that long, trading for 10 years, but I had never seen anything like it in any individual stock. It was massive premiums. And it didn't really make sense. I mean, from a fundamental perspective, you cannot really justify this kind of exuberance, which is what it is. And of course, people want to pay this premium. Yeah, nobody's going to stop them. But what's the problem? Normally, when you buy an option, your counterparty is not going to be another retail trader, at least usually not. It's going to be a market maker. So you have market makers in each big stock, each big company. And what the market maker basically does is he sells you the option that you want to buy, and he will then hedge himself because he doesn't want to get any risk from selling you that option. So how does he hedge himself? Well, the simplest thing would be to just buy the underlying. So he would then buy GameStop stock to hedge himself from any potential losses. Now, what was the problem? The problem is that these market makers were bailing out. They're like, you know what? These premiums are so ridiculous. I don't want anything to do with this anymore. So they basically left everything open. Now, what happens then is that you get a lot less liquidity. You get a lot less liquidity, and basically retail traders are now trading against other retail traders that are selling their options. And this has a cascading effect, which means that the option premium gets even higher and higher. Now, still, how does this affect the broader markets? Because this is just one company. This is just GameStop. This is, I'm not going to say a small company, but yeah, it's not like an Apple or a Google or anything like that. But you saw that it had an impact on the broader S&P index. The S&P was starting to get really negative following this news of GameStop. And the reason for it is that options have been priced for decades already a certain way. And now you see that these old pricing methods may not be as applicable anymore in the current day environment. So you now have to account for a scenario where you get these extreme call option premiums. So in the S&P, you also saw a little bit of an effect there. I utilize the prices of options in my trading strategy quite a lot. They're quite a big input for me. So I don't look at GameStop option prices, but I look at the S&P option prices. And what I saw is that they were also starting to get inflated. So what I then see is that my indicators are starting to trigger. They're starting to detect something which is not really there. It's just an effect from this GameStop. Not just GameStop, by the way. There were other companies, AMC, even BlackBerry and Nokia were being impacted by it. In any case, so this started to have an impact on the indicators that I follow, which was incorrect because the market was not really doing anything in particularly bad. So I figured this is something that may have a lasting impact. So I need to make changes to my strategy. So I basically updated all my strategy rules, took into account that this can happen, that my strategy doesn't necessarily need to make new decisions if this happens in the future. And I'm happy to say that it worked because in February, we got another spike in GameStop, and the same thing happened again. So once again, the exact same scenario unfolded, which is actually quite a rare thing to occur. We're now getting back to it once again. GameStop is once again going down. But in any case, the portfolio took right decisions. Sorry, the trading strategy took right decisions, and we managed to overcome it. So I'm happy to.
That's very encouraging to see the results of your change be tested so quickly and emerge successful. Okay, so this is very interesting, and I'm learning a lot today. Not just about what it is you do, but also who this guy, Marco, is. Because all I know of you is your photograph. And even your photograph is quite distant, can't really see your face. And then I see you answering comments on your feed. Why are there no videos from you?
Yeah, I have been toying with the idea of even creating a YouTube channel myself to explain some specifics. Actually, the eToro PI team has advised me to do so as well. So that is definitely something that could be in the pipeline. The only reason that I have been a little bit distant from it is because I don't know how much the interest would be on such a specific topic, because it's not like I'm going to be able to talk about individual stocks or commodities or anything like that. I have a lot of knowledge concerning the VIX and concerning VIX products, but
Yeah, I don't think copy traders need to know all the nuts and bolts.
exactly.
But if you were making like a monthly review video and saying, this is how February went, this is how March went, and you go, hi everyone, this is Marco, sitting here in Belgium, having a Leffe Brun or something. And I want to talk to you about what happened in March, why it went so well. And you could explain all that stuff about how GameStop affected options and you had to change your strategy and it's now been tested and it works. And look at the February result, look at the March result. If you're looking for someone to hedge your portfolio, consider me, sort of thing. I think that would go a long way. I mean, I honestly think that having a YouTube channel is a prerequisite for any PI who wants to get on. You know, I mean, it's a social trading platform, and there's no better way to get to know someone than to sit and watch hours of their YouTube videos, or at least feel that you're getting a personal update from them. You know, and it's so easy to make YouTube videos. Like, I already know you 100 times more than I did before this conversation, because we're on video link and we're chatting and I can see the whites of your eyes and all of that stuff. You know, that human connection. It's very important.
I agree. Like I said, it's actually something that I had been pondering about, and now that you say it like that, with the whole GameStop story, it would have actually made more sense on a video, because I did list all the details in a post on eToro, but the post got very little feedback, and it's also because it's a lengthy post. It's not very digestible to read. It's an interesting idea, yeah.
People maybe look at your stats and then they try and read the bio and it doesn't really sink in. And they just think, oh, I just don't know what this guy is. So a monthly video of you just saying what happened and what you did and keeping it simple, but explaining why you're a good alternative or additional PI to consider, I think would go a long way.
Yeah, it's a good tip. I will definitely keep it in mind.
Let's talk about the future. Do you think copy trading is here to stay?
Definitely, I think it is definitely here to stay. Copy trading has been booming for the last couple of years. It is something that is becoming very popular. Now you can just invest in people through these platforms. Makes it very easy. You just copy their entire portfolios, copy their future trades, and it's all very visible as well. It's very transparent. Whenever they do a trade, you know exactly when they have done a certain trade. You can look at their entire portfolio history. This is very different from old school investing or getting certain funds with your bank or whatever, which was very sealed off towards the client. You didn't really know what the person was doing with your money. You just get a fact sheet every once in a while that specifies some details. But with platforms like eToro, everything is transparent. You have a total overview, and it's so easy to copy someone. So, of course, I think this is only going to grow in the future.
And if you were a copy trader, what would your portfolio look like?
If I was a copy trader, well, I would look for maybe, I don't know how many I would choose, but I would definitely go for, let's say, between 5 and 10 specific profiles that are preferably uncorrelated, have a good track record. Each has their very own specific investment or trading style, maybe even their own specific products that they trade. And basically, I would set up my own hedge fund. That's the benefit of this platform. You as a copy trader can make your own hedge fund amongst copy traders.
That sounds good. I've never thought of it that way, that I'm a hedge fund curator.
It is like that when you think about it, yeah.
Okay, so I know you have to go quite soon. Before you do you have any ideas for me or advice as to things I should cover more here, apart from trying to educate the listener about volatility trading?
Well, so far I think you're doing a fantastic job. I have caught a couple of your podcasts so far, and I have really enjoyed them. I think it's quite a nice way to get to know certain traders or copy traders. The ones that you had on your show, in all honesty, I didn't know them, so I went to take a look at them, saw their profiles. I think it's a nice way to get to know very specific people, very specific traders and investors.
But I think, is it not also useful, do you think, for PIs to hear copy traders and different copy traders' approaches so they can get in the mind more of what the copy traders are looking for?
Definitely. And because I think there's indeed a lack of, there's a channel missing there. I think a lot of PIs are living in their own little world, and they're not really listening to what the copy trader is asking or wants to know, wants to see. So I think, it is very, very informative, even for us PIs, to have this kind of information and to have this kind of channel that will bring this information to us.
Okay, well, I'm going to let you go, Marco. It's been wonderful. I look forward to the launch of your YouTube channel. I will like and subscribe and leave positive comments. And maybe your wife will be behind the camera directing. Pick out a nice shirt for you. All right, Marco, it's been great. Thank you very much for joining us here today.
Thanks a lot for having me.
All the best.
Thank you.
So that was an interesting journey into the mind of EliteVol, my PI volatility trader. It might be worth having a look at your portfolio, dear listener, to see if it is genuinely diversified. As Marco says, the VIX is an asset class, so it offers something different. I am very happy to have him on the team. PI conversation episodes from this point forward will be with PIs who are not on my team. Unfortunately, my fourth PI declined to appear. Being on a podcast isn't for everyone, of course, but it doesn't help me or you to get to know him any better. In any case, there's no shortage of PIs out there, so plenty of great chats ahead. That's it for today. Thanks for listening. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. It's just generic chit-chat. We don't know your individual circumstances, etc., and so forth.